exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right, Chris.
All right, ask that question again.
Yeah. Okay. So this was the reason I was discussing that was somebody in the audience outside of the United States asked, what's the best way, most cost efficient way to trade the indices and to hold something for, a holding period? Because obviously if you're trading CFDs through like a CFD brokerage, that can get costly to hold positions for, 3 weeks, 6 weeks, whatever. So I was talking about the pros and cons of everything. And I personally trade a lot of ETFs. I swing trade ETFs. I know that there's people who like to do futures, there's people who like to do options. But I was talking about the pros and cons of each. And I talked about one of the big cons is that with ETFs, you don't get access to the market until the stock market opens up, right, which is a major negative if you have something like an August 5th event. So I think we both dealt with a lot of slippage. I was talking about how frustrating that scenario was. I gave back a huge amount of my profits just on that one day for the year. Ended up recouping them, which was great, but it was a very frustrating situation. And I was asking too about options because even the futures market gapped lower on that August 5th day. What was your scenario like with that?
Well, what it did was it blew open the bid and ask prices. That was the hardest part. So even trading it live, this is actually the gap open from Friday the 2nd, which was a non-farm payroll day, to opening up Sunday night at 6 p.m. This is what you're talking about the market doing. So this is a run, literally Sunday night, the market was down 4%. So you're talking like in a 3 to 4 hour window, we essentially had the market blowing open and we were looking at 3, 4, 5% gaps lower on the opening bell indexes. So your SPY, your Qs, your ETFs you're talking about, they were going to be gapping like 3 to 4% lower. Futures was insane that day. I know because I was watching. It was Sunday night, 6 p.m. The market was way down, and I really took notice around like 9 or 10 p.m. Eastern time that night. And so the crazy part is futures would have been the best way to trade it, but your bid ask would have been quite wide, like probably 3 to 4 times wider than normal, if not worse. So, because it was, over the weekend, Sundays are usually pretty quiet, but a Sunday open like that was insanely violent. The markets were going from I don't even know what the VIX was at the time, Nick, probably like jumping from like a 20 to a 40 VIX.
Yeah.
Because that was literally like a volatility event. We went from like a 20 to 60 VIX.
Yeah. Yeah.
So
I pretty much, I guess my frustration, especially with that situation, is because I wasn't trading futures. In the big picture, 3 weeks later, it didn't make a difference if you had just held through all that, which I did not. So I actually took the loss, which sucked because eventually, basically, when the ETF opened up, it was like right towards the bottom of the move, and then it ripped from there. So it was frustrating. I mentioned I was able to recoup the losses through some other trades, which was great. But in that moment, it was very frustrating. And so then my other question to you was, so with futures options, I'm not super familiar with trading futures options, as everything I trade in terms of options is ETFs and individual equities. So with futures options, are you able to trade like Sunday night options? You can. Okay. So you can.
Yes.
Okay.
Yep. You can start as soon as futures is open. You can start placing trades. I've done a lot of futures options trades that it's easier to position like a Sunday. If I wanted to start Sunday night and like prep for the week, I can just put on a trade on Sunday anytime.
Okay.
Usually I just wait until Monday just because we have some, order flows that come in Sunday nights, and Monday's kind of like the official opening bell. But the one thing that's nice about futures and futures options is you get the convenience factor of you don't have to trade opening bell, closing bell for it's for anybody, but like a non-US trader especially. I mean, I have traders that I know that are in Australia, that are in Singapore, that are in Europe, and they're 12 to 7 hours ahead or behind or whatever. Like the time zones are awful. So a futures market that runs 23 hours a day, you can still place similar strategies and mechanical trades using futures options. Like I could place a trade on Sunday that expires on Friday. That's not a bad trade to kind of give myself a run for the week. So example would be, let's fast forward to, current price. And let's say that I think this week, and here's actually, I mean, this is a trade that I actually want to kick around. We're kind of starting earnings season officially this week with a lot of
Yeah, like
financials.
JP Morgan. Yeah.
Yep, it's JP Morgan, Citigroup, Goldman Sachs. Netflix is out there on Thursday, which is maybe one of the bigger volatility ones to kind of keep an eye on. I was going to
Hmm.
fast forward to today. I think a really key level, there's a lot of resistance around 6,300. Like as far as like the SPX at 6,300, that's a huge level this week. And I think that as we just kind of melted up through the last OPEX cycle, like through the end of quarter, end of month, all this stuff for June 30th. We just kind of breached like 6,000, ran up to 61, 62. We're kind of hanging out here. What's interesting, Nick, is this expiration for the 18th, which is a major monthly expiration. It's like 90+% call option volume. So, and
Interesting.
it could be like buy calls at expiring, but I would also imagine a lot of people are selling calls to just take profits at some of these big pops that the stock market has seen. Um, there's not a lot of put protection. You can look at the pricing in the market right now. Let's go to ES for futures and see if this shows the same type of skew that we saw in SPX or SPY. If I go to a futures options trade right here, and I'll just guess. All right, so I'm going to go out to the 18th and say, okay, I think by Friday, this week by Friday, I don't think the market's going to be above the expected move. So right now, futures options for ES, I could do some type of trade like, let me do a call fly here, just see if I can get something to pay me. So if I were to say, let's go down to the expected move around 63.70 or so. If I pin the expected move and give myself a little credit here, so I can risk about $400 to make about $100. And
Mm.
there's a profit trap there. So it's a little backwards, but that's an out of the money trade that says the S&P futures market will be lower than what's the expected move.
Mm.
So if I put a cap on the ceiling or the cap on the other move this week and said there's a ceiling, I don't think we're going to go above this. That's not a bad way to look at it. And I could set this trade. I could have set this trade Sunday night and let it go all the way for Friday's expiration.
Sure.
Makes
Well, there
sense?
you go. So for people who are outside the US, especially with the limitations on ETFs for certain places,
Yeah.
probably the way to go is if you're somebody who wants to hold indices for a longer period of time, or you're interested in doing the option side of things like Chris gets into, futures and futures options might be the way to go. I think actually, just generally speaking, futures they're highly liquid. They're a great way to go in terms of if you just want to be long SPX or short, Nasdaq, whatever. I think that's a way to play it. Chris, I'm going to back out of here and let you take over for a little bit. Before I hop out, just for anybody who enjoys the commentary from Chris, make sure to find him on his own channel. He has a YouTube channel. You can find him, Chris Pulver. Just search him up on YouTube or socials, and you can find him all over. And of course, if you want access to his trading signals, they are also available inside of our group with the Pulver Alerts service. If you have some questions about that, feel free to explore the Pulver Alert service here. Chris, thanks very much for taking over the show, and enjoy it, man.
All right. Thanks, Nick.
See ya.
Bye. Just one quick thing on the option stuff. If you do sign up for Pulver Alerts, you do have access to a bonus course called Practical Options, and it is 13 of my favorite option strategies. They can be also thought of through the futures market as well. So taking a bull call spread or a bear put spread or a bear call spread. Anyway, debits, credits. Here, I'll just show you a quick sneak peek. So this is where I usually let's go to practical options. There we go. So this is the bonus course right here. So usually I'd sell this course for $497. This is included with Pulver Alerts. So if you get Pulver Alerts, you get my alerts. I give you this practical options course. You can see here, like, as an intro on just going through the entire strategy guide. I have a PDF that goes with this that I walk you through key terms and vocabulary. A lot of times the learning curve that comes with learning options is just the terms. What is a call, what is a put, what is a debit, what is a credit. The Greeks, like some of the things, like it just means if price is moving, that's a delta. If it's time, that's theta. They're stupid names, like all the stuff that comes with options and terminology. It was created to sound really smart. It's really just understand, if I'm taking this trade, what does it mean? So that's why I'm literally like breaking this down to the simplest details of Practical options meaning this. Do I know what the trade means? If I, buy a call here, what does that mean for my trade? What can I risk? What can I make? If I create a spread trade, what do I risk? What do I make? Where's the line in the sand for risk or reward? So I break that down in hopefully the simplest details here. Break through a risk graph as well, or walk through a risk graph when things show up. I mean, for example, if I did that I was doing a butterfly spread as an example. Um, so if price is here on the the ES, we'll go futures. Price is here, and I wanted to position myself. So I'm going to say the market can't go greater than 63.70. Okay, so I can make a trade that looks something like this. There's my credit. There's my profit trap. There's my risk, and I can build a trade where I get paid here. If price goes nowhere, I still get paid. If price goes down, I still get paid. If price goes up, I still get paid. If price goes up a decent amount into my profit trap, I still get paid. I have, some risk obviously if price goes too far to the upside. So maybe it does. So I take risk and I'd risk $400, but I can make $100 here and I can make about $300 here. And I'm giving myself about an 80% probability profit on that trade for Friday's expiration. So that's what a risk graph looks like. And sometimes it's just a little confusing to see it. So I try to make it really simple. Looking at an options chain, most brokers are the same. I mean, you can look at a Tasty Trade Broker. You can look at Thinkorswim. You can look at E-Trade, Fidelity, Robinhood, Webull, whatever. All major brokers like stock brokers, equities, indexes, futures, like Interactive Brokers, same thing. Option chains are pretty much the same. You have your underlying asset. Okay, you have your expirations, you have your strike prices. So once you can navigate kind of one option price or one option chain, they all kind of look the same. Strategy guide, and then the strategies here: buying calls, buying puts, bullish spreads, bearish spreads, calendar spreads, butterfly spreads, and these are all directional trades. Then you have also non-directional. So I'm trying to give enough guidance and material to say whether you want to trade the market up, down, or sideways, there are strategies here in this practical options. So I say all that to say, if you get the Pulver alerts, this course is included, right? And I'm hoping if you really want to do even a basic dive into options, you can take in a lot of information here and be very, very knowledgeable with getting started and comfortable placing options trades, understanding what that reward and risk is at all times. The nice thing, actually, I ran this test this morning. I thought this was interesting. So I just ran a morning session. We were talking about this. Can everybody see this right here? Okay. This didn't happen. And I know that because the way that I trade in the morning, everything that I'm doing for options is risk defined. Okay. Which means the trade that I would have been taking in this example would have been something like I would do like a 15 wide on the top and a 15 wide in the bottom. So let's say this is current price of the asset. So I'm trading SPX as an example. So if this is SPX price in the middle, and I create a spread up here and I create a spread down here, the most I can lose on this trade is if I did a trade for, let's say I get $2 credit. Okay, that means that I'm risking $13 in risk. And you might think like, that's crazy, that's so much risk. Well, when you win 97% of these trades, you can still make money. When you win 81% of these trades, you can still make money. So this is the strategy that I do quite a bit, and I do win about 90% of these trades, so it's quite profitable. But it's typically not a favorable reward to risk. And some people have a huge reluctance for trades like that, and some people can't ever wrap their head around like trading backwards reward to risk. But it's all about probability. So point is, I know that if I took this trade, my max risk would have been about $1,300, and so this max loser was showing 24 grand. The day that showed a $24,000 loss was April 9th. Okay, April 9th of 2025 was the day that Trump said, great time to buy stocks, and it was the Trump pause and the Trump pivot, right? We put the 90-day pause on, and what did the market do? It had one of the biggest rips we've seen in 20 or 30 years. This trade is still risk defined. There's no way that I would have lost $23,000. So I still took the bulk of the loss. I took a $1,300 loss, but this went from a P&L of negative 15 to plus $7,500. So it changed everything about the test. So even that is an outlier. And I looked at the data, it's like April 9th, if I placed a trade that day. Now, granted, we would have had like pretty wide bid-ask prices because that was post-Liberation Day. It would have been April 7th, would have been like the big dump for the day. And then April 9th was like 2 days later. The market rips on. I think it was had to be a Wednesday. I'm pretty sure it was a Wednesday because like that Wednesday or Thursday, the next day, like I was traveling. That was like during the Masters week. And if it wasn't for that day, if it wasn't for the market ripping up the way that it did, I probably wouldn't have been in Atlanta that day that I hung out with the A1 team and tried to actually enjoy the rest of the week and not feel like my year's going to crap with everyone else's. So anyway, but the nice thing about options, that was just a long way of saying you can trade risk defined. So all option prices is you have a price and time. That's all it really means. Okay. And over that price and time that you select, you're either going to make money or you're going to risk money. And so I like to have trades that are risk defined. So even if the market were to go to zero, which we know is probably never going to happen on the indexes or the markets, right? Or time obviously is going to pass regardless. Like there's no way to stop time. So price goes up or down and time is going to come to an end. My expiration is always going to come to an end. And at some point, I'm either making money or I'm risking money. And all it is a game of price, time, and if price is above a certain level or below a certain level, I either make or risk dollars. And you can make that as huge as you want, or you can make that as small as you want. And I tend to trade in that kind of sweet spot where my risk and reward is pretty comparable. If I'm going to risk, $500, then I'm looking to make hopefully $250 to $500 with a high win percentage. If I'm going to risk $500, maybe I can make $750 to $1,000. It's no different than anytime you look at a futures trade or a forex trade and try to say, well, I'm going to go after, I'm going to risk $500 to make $1,000. Cool, you can do that in options. But the nice part about options is you don't have to deal with all of this stuff that drives me crazy as a forex trader that's been doing that for 17 years, and as a futures trader that watches the market manipulate highs and lows just like it does in forex. Which means if I placed a trade, let's say that I wanted to short the market. And how many of you have had this experience in futures or in forex? Okay, if I were to sell right here, okay, and put my stop loss right here, what happens if price does this? Spike and then down. You get stopped out. You lose money. And the broker takes that money, and you're out of that trade with a loss. And then the market goes the way you thought it was going to go. Okay. That is manipulation that happens all the time in Forex, in futures. Options, you eliminate that. Why? Because if I were to place a trade, crafting a trade that says if price stays below this line, I make money. And price can go here and 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 here, all over the place. My stop loss doesn't matter until expiration. So I could sit in this trade for a week. I could sit in this trade for a day. I can sit in this trade for 6 months. As long as price is below here by expiration, I get paid. If price is above here, then I risk. But there's no manipulation in an options trade. It's just price and time, right? That's kind of a good thing. That's why options to me are incredible. I think it is a very fair tool for retail traders to consider because you eliminate a lot of the frustration with getting trades right on a chart, but somehow losing based on a high or low that's being manipulated and tested over and over and over again. Type in a wire yes if that makes sense. Okay, so if you're interested in learning more about options, I think jumping into the Pulver alerts, soaking in that practical options knowledge, and hopefully it helps. It'll be just a really quick crash course into introducing you to options, giving you some of my favorite strategies, and then thinking about the market in terms of where's my line in the sand, where's my reward, where's my risk, and then letting trades play out. Not that difficult. Okay, so there to help. All right, let's talk top down here. I have a hard stop at 11 o'clock today. So let's talk some macro. This week earnings, we kick off. I think I have a screenshot right here. This is kind of the earnings play for the week. Big financials, a lot of it's led by, JP Morgan tomorrow morning, Citigroup, Wells Fargo, BlackRock, State Street, BNY. Let's see here. We've got some transportation with JB Hunt. We have Morgan Stanley this week, also financials, Bank of America this week. What are some non-financials? We have United Airlines, Alcoa, Kinder Morgan. We have Pepsi, Travelers Insurance. We have Progressive this week, I believe. Progressive Insurance, I thought. Yep, Progressive here is Wednesday morning before market. Netflix on Thursday after the close of Thursday afternoon, 4 p.m., whatever, when it's announced, and then we'll see Friday trading on Netflix, whether it's an up or down. If I take a trade on Netflix, I'm likely going to go out not this Friday, but the following. Because I mean, I don't know. Netflix can surprise us a lot of different ways. The market might love it. It might move way beyond the expected move. So I'm pretty cautious on some of these like highly sensitive stocks when it comes to earnings. Interactive brokers, kind of the trading business. I think for stocks like Schwab, Interactive Brokers, Robinhood, they've been doing really well this year. Robinhood especially is kind of off in its own island with like tons of upside, and a lot of people are crazy bullish on Robinhood right now, which good for them. I'm still, a little. I mean, I have Robinhood exposure. I just, I was annoyed for what happened with them in 2021 with GameStop, and I did lose a lot of respect for them. But I know, look, give them a chance to come back and make a presence in the industry, which they are. I mean, I believe they've been a great disruptor. I think if it wasn't for Robinhood coming into the space of trading, we wouldn't have free ETFs. We wouldn't have fractional options. We wouldn't have Acorn. We wouldn't have like all these things that are just like, look, make it easier for people to invest. I think Robinhood had a lot to do with that. On the negative side, they were pay for order flows and they were democratizing, and they said it was for everybody when really they were still getting paid by big pockets like Citadel to basically pay for order flows. And when everything happened with GameStop and Melvin Capital, that was the whole thing where they froze their platform, turned it to closing only. You couldn't buy more shares of Robinhood. It was just a stupid like week, but obviously there were days and days and days of nonsense leading up to that freeze. So I had a Robinhood account. I have friends that had Robinhood accounts, and I was actually saying this is a good time to move stop losses. This is a good time to take profit. This is a good time to get out of this trade. This is one of the crazier things I've been watching for a while. And sure enough, just a few days later, it was like frozen, can't do anything. And all of a sudden you have like 60, 70, $80 gaps to the downside, and people are watching all these profits disappear. So I did lose a lot of respect for them. I closed out my Robinhood account right after that GameStop debacle. And it's fine. I didn't really look back. But as a stock now, I mean, Robinhood has been pretty exciting to see rip from the teens. I mean, they essentially became their own meme stock. I mean, they're trading at $11 back here. Here's the drama here in 2021. They IPO, or I don't think they SPAC'd. I think they IPO'd, but became their own meme stock, right? They open up at 35, rip up to 85, and then flush down to just nothing. Like Robinhood's garbage, $10 a stock, $9 a stock or share, and now they're up to $100. So it took time, but that's just that big trough, and life goes on. So what do I see now in Robinhood? Overbought conditions with divergence on the daily time frame. To me, most likely mean is something that we should be able to fade. I think we should be able to fade this move and see some success there. Okay. Let me ask C's question here. X says, great talk about options. New looking to learn more about options. Yeah, I mean, a great spot to learn is grab your Pulver alerts, get the practical options course to go with it. So that comes with the A1 Trading Pulver alerts bundle. I'll give you this course. If you just want the course, you can have it. It's there's an on-demand page here if you just want the course. So that's the full options course. I also have this. I have one that's also a little bit more bite size. Let's go practical options. I've got a quick options course for $27 if you just want to like, just test the levels of options. Okay, here's a quick guide here for about $27, and it's just basic option strategies, but you can still trade the market up, down, sideways, understanding there's time and price that's really all to pay attention to. So if interested, there's this, but like I said, I include these with the Pulver alerts with A1 Trading. So, if anything, get your Edge Finder, get your Pulver alerts combo, and get the practical options included for no added cost. But if you want to just buy them a la carte, they're there. Okay. But that's, again, to me, I taught that as if like, I built that course kind of like my nephews were in mind. I've got a 17-year-old nephew, 19-year-old nephew. Hey guys, you want to learn some options? Hey, I've got clients that are, 70 plus years old, 80 plus years old. Just to understand a basic, it's like some clients that I trade for, they still like to kind of manage a few bucks on their own, but just to have some fun, just to learn a couple things, give them a couple strategies, express something in the market without taking on a lot of risk. So I give them a course like that. I kind of built it out for something very simple, get rid of like a lot of the learning curve confusion that comes in with like all the terminology, looking at a risk graph. It sounds so sophisticated. All these strategy names are so crazy. What's a jade lizard? What's an iron condor? What's a broken wing butterfly? Nobody cares. All you have to do is understand, what is the trade telling you? Where's my risk? Where's my reward? What does it all mean? Can I plot it on a chart? Like everything else is it's just funny stuff. So simplify it. All right. Okay, currency strength for the day. Let's have a look. So today we've got New Zealand and Aussie week. Things are still pretty quiet on the Forex side. I really haven't seen a big Forex day in a while. I can't tell you the last time I saw 100 plus on the vertical axis here in anything Forex outside of maybe the Japanese yen or the pound in the last couple of months. It's been pretty tight. Even the dollar, which I said, look, I'm not selling the dollar at these lows, which so far I've been right. I think that the dollar, having a little bit of a pullback off the symmetry zone makes some sense. I still think even at 97, almost 98, the dollar is still likely going to pull back into like 100 or 101. If we have some risk off trading in the market, I could see bonds catching a bit of a bid. I could see the dollar catching a bit of a bid if the market is likely going to pull back. So, how high does the S&P go? I think at the very least through this first like week or two of earnings season, this week is all financials. We'll see some forward guidance. Next week, we're going to start to see some Mag 7s dripping in here towards the end of the month. I would love to see, this is a 21 period moving average. This is a 50-day period moving average, then a 100, 144, 200. This is all supported. Even a move back to the 21 is supported. It's shallow. It's aggressive. This will still be a very aggressive bull market if we bounce here off this 21-day moving average, like previous all-time highs. We bounce off the 21-day and come up to these highs again. Do we have room to get higher? I personally think that we can at least make a run back to this 50-day, which puts us around 6,000. I mean, we're trading at 62.51. We had highs here around 62.90. Can we get back down to around 6,000? Now, this might be seen by some as a line in the sand that's really important. To me, this is still support. This is still support. This is still support. The big break for me to be like, okay, this might be a little bit more of a concern would be if the market convincingly breaks below 57 and stays below 57. That's where I would say, maybe this market is setting us up for like a monster top. Okay. But if we fall into this 50-day moving average and we stall a little bit and then fall a little bit more, as long as we pick up some support around this 5,700 handle, I think this is allow the market to find a base, allow the market to work its way back out. We try to hit all-time highs and kind of run into the end of the year. So my pullback window is kind of now until September. I know that's a big window. I know that's not going to help anybody that wants to trade short term, but to me, that's a big enough window to say I think we should technically have a decent correction in the next 30, 60, 90 days. If we don't, I would be shocked, because if we don't have really a correction, what's next? If we don't have a correction, there's only two things that can happen. We either go absolutely nowhere for the next 60 to 90 days, which is also a possibility, although rare, it's still a possibility, or the market can somehow just keep grinding higher, slowly, but grinding higher. Okay. Is the market capable of blowing the top off? Well, of course it is. My concern is if we have a blow off top, which I thought this kind of was a bit of a blow off top to me after that ceasefire agreement. That ceasefire was a bit of a blow off top after the market was, kind of just grinding towards all time highs, and then boom, blows through it. Doesn't really even acknowledge 6150. Didn't even pause at 6150. And here we are, 100 points higher. So if we grind a little bit higher, okay, fine. But at some point that structure changes. We still get a pullback. All these moving averages are still going to get hit. They'll still get hit. So I'm just a little bit more cautious in the short term, waiting for dips. I hope we get something. I mean, I'm willing to wait 30 days. I'm willing to wait 30 to 60 days. I think by the end of September, this market at least has a pullback that I think we could position for. So, like I said, cautiously bullish. Like this trade up here, this is a trade that on an options chart looks like this. So I have a buy call, and then a sell call, and then a sell call. So what that means is I'm looking at a price where if this is price, it can go all the way up and increase in value by another 5 to 6%. And if it gets up to that level, I have a little credit here, I have a profit trap, and I have some risk. So price can go nowhere and I can still get paid. Price can go up a little bit, I can still get paid. Price can go up 5+% on an index, I can still get paid. Price can obviously fall and fall and fall, and I get paid. So that's a trade that I'm in, kind of defending the time of like August and September. I think by that window, price has at least made a pullback here, and that trade should get me paid. So that's one way I'm doing it. We'll see if it plays out. So I have about trying to think. I'm risking about $800 on that trade. Max profit could be, I think, around 700, about $700 if I'm right. If I'm like spot on, it'd be about $700 in profit. I'm expecting to win about $390 though. Just the higher probabilities I win about $390. But I'm risking about $800. Okay, but I think we still have a pullback at least to the 21 period, more than likely because of the point differential, and we haven't seen the markets push this aggressively above a 50-day in a long time. I think we at least pull back to the 50-day. So that's not nothing. Like a 250-point drop is going to get some attention. I mean, that would be a decline of about 4%, give or take. Obviously, the 50-day moving average will catch up, and it might decrease that decline a little bit. But I still think we have a reasonable, 3, 4, 5% pullback. If it becomes a little bit more than that, just like we had back in July last year, market went down, stalled, down again. That was about a 9.9% correction. Okay. So we can get 5 to 10% reasonably in the market, pullback wise. And it doesn't really change the integrity of a bull market at all, right? It's when you start to get 15 to 20%, like you saw here, where everyone thinks, oh my God, the market's bearish. Well, obviously there's reflexivity to the market too, as illustrated by what happened post, April 9th. So I'm looking at some type of correction. I don't know what the catalyst is going to be. The market might be doing the old buy the rumor, sell the news August 1st, because now that's supposed to be the big bad tariff deadline. The tariff talk isn't over. I mean, the Trump taco trade is okay. So we want to tax Canada. We want to tariff Canada. We want to tariff copper. We want to tariff Brazil. I mean, we're still talking trade war stuff again. So it was quieted here, and it's almost as if Trump gets a little bit more brave at all-time highs to say, look, I'm going to throw out some tariff conversations here. Right? Why? Because we're sitting at all-time highs. What could go wrong? We have some support, right? We have some insulation to kind of cushion this blow. But when the market was down here, he was very quiet. Like, shut your mouth, dude. You're going to break the market. So we pivoted. But it just seems like it's a little bit braver here at all-time highs when the market's showing that the US is resilient, and all of a sudden there's an understood kind of cushion where it's like, if we don't tariff the world by more than 10, 12, 15%, I think the markets are taking that in stride. It's the shock tariffs like 25, 35, 50+% that just seem completely subjective that the market doesn't really love. But there hasn't really been like an adverse market move here for the last couple of weeks. Yes, I mean, last week we closed lower, but barely. I mean, this is where the market opened for the week, where the market closed for the week. Like a fraction below it. It was barely negative last week. Okay. So is this a sign of a top? I don't know. I mean, we had a nice little run up through that trade war. This is the ceasefire agreement. So the US-China trade agreement gap was back here. That's still alive and well. Here's the ceasefire agreement where the market ripped up. And that was kind of our two big thrusts in the market the last couple of months. Now that we are kind of stalling here, I still think 6,300 is a key level this week. Honestly, I'm looking to kind of fade off of 6,300. I don't think we go too much higher than 6,300, in all honesty. I really don't. But to me, the safest way to play that is not to express that as in like, it's got to stay below 6,300 this week. I mean, what I'd like to see is for a given week, as far as like day-to-day volatility. I mean, in a given week, we're looking at a VIX around 16 or 17 right now, which means the market is expecting about a 1% move plus or minus every single day. So there's enough volatility to potentially, and it's rarely going to happen, but potentially have the market go about 5% plus or minus for the week. Okay, so if we went up 5% from right now, 5% up right now is going to put me up into that like 6,500 zone. So current price go up about 5%. So we'd be at 6,550. Okay, if I show you this on an options chain, let's go out to the SPX. Let's go to the end of the week, July 18th, and let's see what the broker says. Well, the broker has here based on current volatility, current IV rank, current plus or minus market maker move. The broker's looking at about a real move about 6,320. That's on the high end of that's like a 20 delta. So there's about an 80% chance that price stays below that. Okay. So that could be my way of expressing this week. How to stay out of trouble is if I look to sell, it's like I'm selling above 6,300. I'm trying to sell above 6,325 or 6,350. I don't think that price is necessarily built in this option chain to go higher than that, right? The famous saying is bulls climb stairs, bears jump out of windows. That's my saying. Like a lot of people say bulls climb stairs, bears take the escalator or the elevator. I'm like, that's the elevator is silky smooth. Like bears just jump out of windows because when the market falls, it falls aggressively. So anyway, if we're going up, it's really, really slow and steady. If we go down, it's like just a rip to the downside. It's all about shock and how quick things are moving, and then volatility changes, bid ask gets super wide, and it makes trading pretty disruptive, right? So anyway, I think it's pretty safe to be selling above 6,300 this week. And honestly, selling above 6,300 for the next couple of weeks, because unless I see price really convincingly making a run above 63, I think we have some room to pull back. So to me, that's really going to be my focus. I think we don't see price going too much higher than like 63.50 or so. And again, if I'm wrong, it'd be defined risk. I benefit from market melt up. You know, I've been hitting fresh highs in the portfolio with this melt up. We've had a nice run on silver, which has been a nice position for me. We've got a nice run on Bitcoin. Bitcoin's up 13% in the last like 4 or 5 trading days. You know, it's up to 119. That's pretty exciting. Now the question on Bitcoin is where do we stop? Does Bitcoin go to 120, 125, 130, 140? I mean, I don't know. It's kind of exciting. I'd expect there to be a pullback at some point, kind of retest some of these key levels. Okay. So anyway, but I just think technically speaking, it is more technically likely to have the market just try to retest, try to go sideways and let these moving averages catch up, or try to pull back to find them. If the market pulls back to find them, there could be dip buying. Okay. But that at least gives us a chance to buy something cheaper. If the market melts up a little bit, you know, I mean, what do we have going on this week? Earnings. We're just kicking off earnings. Is this the type of earnings that's going to send the market sky high? Probably not. Financials are usually pretty boring. They're usually pretty low beta. If you go to XLF for financials, you know, we're sitting on this sector at all-time highs, just off of it. So do I think the guidance will be like amazing on financials? I mean, they're probably excited that rates are going to be cutting, right? I mean, the Fed's expected to cut rates 2 times this year, maybe 3, but it's like 5 to 6 cuts by the end of 2026. You know, what other drama do we have going on? Trump and Jerome Powell, right? I don't know. I mean, I hope for Powell's, like his legacy's sake, that he just holds firm. I really like it's fine if the Fed wants to cut 1 or 2 times this year. I think the most important thing for the Fed cutting rates is that they do so and the bond market doesn't react adversely. That's the most important thing, because if the Fed cuts rates and the bond yields go up, that's going to be the same story that we had before. Yields are higher, growth is slowing. Even if we're cutting our way through it, the bond market is telling us something different. And there again, another good saying is deficits can continue to grow until the bond market takes away the keys. So we can have a government that's just spending recklessly and adding to the deficits, but the bond market says, look, man, we're going to increase yields by, 50 basis points. We're going to increase yields by 100 basis points. This will cause our reality check in the markets. It did last September, and we did through Liberation Day, and we are looking at maybe global yields continuing to rise and stay elevated. This is why the Fed doesn't want to cut. They don't really want to cut. Inflation still hasn't hit sub 2%. They don't want to cut, but the pressure is mounting, right? Because if they are truly behind and we have this like ability to navigate a soft landing, and still the labor market is steady. But it's an interesting correlation, because usually when the Fed starts cutting rates, yields should follow. But last year that broke. And so I wonder this year, like, will the bond market still be like a rebel? Will it be like the bond vigilantes and the rebel? Maybe. Because if that happens, I think that we're just going to head into like either an asset bubble or some type of like stagflation that is not going to end well. And this market might, I don't know, man, this market might have like this weird Trump 2.0 mega bubble, And his legacy is, look at what I did. I created the greatest market in the world. We're at all-time highs. Everyone's happy. Everyone's got all this money and wealth in their investments. And then it all comes crashing down with a 30, 40, 50% correction. And it's not on Trump. It's the next president, right? But it's like all these things that are being created, policy-driven, a decade of irresponsible fiscal spending, which started with Obama and started with Trump, even though Trump was, the disruptor. It still increased the deficits. It still was heavy fiscal spending. Biden took that to an extreme through COVID, 2020 to 2024. That fiscal policy really kept the markets churning along through a bull market in 2023 and 4. Long story short is you got to watch the bond market. You got to give it the fair credit. Bond traders, probably some of the smartest and most sophisticated traders in the world. Although I would say if you're just holding bonds, I think it's a terrible trade. The one thing I'm probably the most concerned about as far as a black swan event would be some type of break in the dollar or a break in the US bond market. Like TLT again is just not really catching a bid. I know you can trade bond futures. This is something I see a lot of good traders doing right now. Is every time they're coming down, they're just like taking nibbles and just like you're either selling premium and trying to grab some scalps, or you're buying lows and you're trying to grab some scalps. Like this is a very stable market right now after the disruption through Liberation Day. This was the basically the April 7th, 8th, 9th was when the market got really disrupted on bonds and yields. And that was when the Trump administration pivoted very hard. So I don't see the bond market necessarily going, too much lower in a violent way. But I just think that if we hold these levels, we have some bids. But now the question is like, how bid does it get? Do we have like a squeeze in bonds? Remember, this is bonds. Do we have a squeeze in bonds coming, or do we have like yields go up and bonds continue to go down? So if TLT goes lower, presses lower, it doesn't look like it'd be too much lower than maybe $80. You can go back to like, I don't know, to early 2000s. Yeah, so this is 2001, 2002. TLT was down to like $81. So it seems like a no-brainer trade, like, oh, just buy TLT, and then what happens? What if it breaks? What if that's not the floor? So I'm like, that's my caution this year. Something snaps in the dollar, something snaps in the bond market. It's very disruptive to equities. And the cycles happen so much faster now that it's silly to make these like big, risky bets. So I'm not. Okay. All right. Like I said, I got a hard stop here in about 2 minutes. So I didn't have a chance to go like super top down, but at a glance, S&P is flat in the day. Nasdaq is clinging to some gains. Dow is flat. Russell is up a little bit. Volatility has jumped up from, last week we had lows in the VIX around 1570. Now it's up to 17. Dollar index still catching a bit of a bid off these lows. So I'm not selling the dollar. I'm waiting for the dollar to kind of work its way into like 100, 101 again before I start looking to fade the dollar. Oil still pretty good support at 65. Natural gas, I might be adding to my diagonal spread here. 1650 out to August. I'll watch that one. I'm going to set a chart alarm here at 1650. See if that's going to get called away for some income. That's out to August 1st. Gold, still waiting for some pullbacks into my 144 200 moving average. Silver, nice little pop to the upside. Good spring. I still think silver is very well supported at like 37, 36, 35. I'd like to buy some dips on silver. I might look at a futures trade actually, get a futures trade on to see if I can like keep it out of the way of these lows. Bitcoin up to 121 and change. We were up to highs at 123, almost 123.3. Measured move on Bitcoin up to about 132. So if I was going to be taking some profit, not a bad spot to do it, or at least buying some protection. All the above. Okay. All right. I got to run, hard stop, and let's come back and do this again tomorrow. All right. Thanks, everybody. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.